What's up, you opportunity cost investors? My name is Lukas. I'm from excelwealth.com, and today I'm doing this video together with my friend Jessie from Opportunity Cost Investing. Now, if you're interested in, of course, the actual stock split and a whole theory behind it, but most likely the tricks that you missed. If you're interested, check out today's video because we will go through them together. Okay, let's get into the video. So the thing is, actually, if you haven't subscribed to our channels yet, be sure to hit that subscribe button that we have in both of our videos on both of our channels. Be sure to hit that subscribe button, and if you like the video that we're doing things together, be sure to hit that like button as well. Okay, let's get into the video. And hey, Jessie, I actually want to ask you, so what are we going to discuss today?
Yo, Lukas does a better job at that than I do. In this video, we're going to provide a paradigm shift in the way we think about stock splits, even more so than the truth we've been already told.
But okay, Jessie, I'm actually just wondering, doesn't our audience already know the whole truth behind stock splits?
And while I'm glad that we covered that misconception, as it's so common that it even exists in that cash flow board game you see behind me, that's not the way we should think about stock splits. And there are other myths we have to disprove, such as there's no change in market value. In fact, that myth is so common that if you go to Investopedia, word for word, it says the market capitalization and the value of the company does not change. And professionals say the same thing. However, how can that be true? What about the cost of the split and the time it takes to do it? Much like people, companies are affected by splits in different ways. I think I'm stuck. That's what I get for missing an episode of Yoga with Jenn. I think I'm stuck. Jenn, help!
Because in the end, it's just very simple. You know, Tesla and Apple, the only thing what they're just doing, the stock price is over $2,000 already. And no, not everybody can pay $2,000 for just, one share. And to be able to help those people as well, they'll just, split the stocks in 5. So what actually happens is somebody will be just cutting up those stocks into little bits and pieces so that each stock will only be valued like 400 or so bucks. And all of a sudden, hey, you can buy a share of Tesla again. Isn't it just that simple?
Now, I've watched dozens of YouTube stock split videos, but my man Nolan Dalman did it best, and he'll be linked in the description below. Definitely check out his channel. He uses a stick of butter to represent one share of a company. Now, usually you see YouTubers split this into 4 or 5 equal parts to show you that you still have one stick of butter. You now have smaller pieces of butter, so it's easier to eat. By the way, don't eat sticks of butter. I better get this right on the first try because I only have one stick of butter. My girlfriend's going to be so ticked off when she finds out what I'm using the butter for and why it's gone. I hope you all like this video. But what really happens, and this is how I want you to think as opportunity cost investors, is that the company has to have a meeting to discuss having a stock split. And it's going to be a small part, but you'll see how all the other parts will add up. This will usually involve consultants or market analysts because you have to know to do a stock split, and then you have to know to what extent. After that, you have to get it approved by your shareholders in most cases. After that, you have to comply with SEC guidelines that suggest you notify the SEC within 10 days of all the eligible shareholders. After that, you must also comply with your exchange listing guidelines. For example, the NASDAQ requires you to notify them through many different forms, and that your annual fees might increase. If you increase your total shares outstanding, you could push your company to pay up to $20,000 more a year just because you decided to do a stock split. Now, this represents the cost of the stock split, only to an extent, because in that same time, the company could have used this to make more money. So this is your opportunity cost. From here, we have to decide, was this amount of butter worth doing the stock split?
Really? A butter stick? A butter stick? Why would you put butter on a stick?
Both the time and the money that was used for the stock split could have been allocated in the company to provide more value and to grow the company. So once we find out what their actual costs are, we have to weigh them with the benefits to see if it was worth it. So, Lucas, remind our audience again, what were the benefits?
So the benefits of doing a stock split, I'll tell you this, there is more to it than you really think so. Because back in 2013, there was a research conducted by Professor Gunaranta, and he actually looked into the liquidity of stock splits the moment the companies start splitting their stocks. And the concept is actually quite simple, because the only thing is they start cutting up their shares. There is more to it than we really think so, because there is a supply and demand issue of this. Let's just pretend that Tesla has 1 million shares right now, and they're cutting up all their shares into 5 pieces. So what happens? Yes, they get 5 million shares. It makes total sense. But the thing is there a demand to those 5 million shares? That's the first question. Because the moment there is more demand, yes, we need to have more supplies to fill up the demand. But the thing is this. So it doesn't work like this that, all of a sudden you had 1 share of Tesla, all of a sudden you get 5. And then, the value of those 5 are the exact same thing. And as if Mr. Musk would say, nothing the matter, you just get 5 shares and it's the same amount. But the thing is now, all of a sudden, you could say, you know what? I don't want 5 shares. I only need 1. So you're going to start selling off all. So that the supply and demand, according to this research, also evaporates as well. All of a sudden, people have different wishes. People have different preferences. And that causes the market to dilute slightly, saying like, you know what? I don't want to have 5. I'm okay with having 3. Or just because I know that I have 5 right now, and I know that the shares and the value of those shares are growing, you know what? I'll start selling off my shares as well, causing those shares to rise in a price. And all of a sudden, the liquidity of those shares start to grow as well. Because, hey, it's easier for you to sell off shares because you own more right now. So yes, there is more liquidity, and creating more liquidity is interesting for a company like Tesla. But on the other end, we're talking about cost, right, Jesse? Because it can't be just, you know what, I'll just cut up everything and all of a sudden we only have advantages to this. There must be some cost to it by doing this, right?
Let's keep in mind that opportunity cost looks past present cost of conversations with bankers and lawyers and consultants and personnel, but also looks towards future costs. Because I can almost guarantee if a company is willing to split their stock once, they're going to do it again. And just like in Apple's case in the past, they're going to have to authorize more shares, which also comes at a cost. So I hope they're saving their pennies now. Also keep in mind that when companies authorize shares, that might dilute your interest as a shareholder. So that's another thing to keep in mind. But alright, you get it. We're losing market value. Well, at least we're all losing market value equally. Isn't that right, Lucas?
But losing value? No, it doesn't really happen like that. It's not about losing value or in the market. It's not about that. Now you gotta see it like this. So an app, for example, a brokerage account like Robinhood, what they actually do, they allow fractional shares, because fractional shares are very interesting. Now it's not that a company like Tesla sells their shares in a fraction. They're not telling like, you know what? You can't pay up 1 full share. You know what? We'll sell you a 0.2 share of Tesla to you. A company doesn't do that. But a brokerage account and a company like Robinhood, they actually do. They'll just say, you know what? We'll buy 1 share of Tesla and we'll sell 1/5 of the share to you as an investor. Because you're saying, you know what? I want to invest this amount of money every month and I'll just give you a part of that. So what actually I do as a brokerage company is I tend to do the controlling of those fractional shares. I tend to control the whole amount, and I'm giving a fraction to you. And this is what Robinhood actually does. So the moment a stock split happens, what they do is they'll cut up every fractional share as well. And this is how Robinhood makes their money, of course. Then again, on the other end, we've got, for example, an investing app like Trading 212. And yes, I've talked about this app as well. If you want to check that video out, be sure to click on the pop-up button over there. But Trading 212, they do it slightly different. They do actually something called cash in lieu. And actually what that means is it's very simple. Instead of saying like, you know what, Apple or Tesla did a stock split and we're going to cut up everything as well, that's too much work. You know what? We'll just exchange your fraction of the share, we'll exchange that for money. And you know what? You'll get your money back. Let's just pretend that you own 0.9999999 shares of Tesla. Now, instead of saying like, you know what, hey, you owned one, you know, just instead of you getting 5 all of a sudden, a brokerage account like Trading 212 would say, you know what, because we do cash in lieu, instead of just giving you 5 shares, which is not completely true because you didn't have 1 share, we'll just give you cash instead. So, you know, that's it. You know, we'll just exchange your shares, the value of the shares, we'll exchange that into money, and that's what you get. All of a sudden, instead of owning a stock, you own money again. Like, dude, I don't want to have money, because the moment money comes into your wallet, the government is like, hey, hello, we're going to take some taxes from that money that you got. So yeah, all of a sudden, the whole game of investing has turned into money. They've cashed out for you. So Jessie, I'm actually wondering, are there any other gains on fractional shares then? Like, are there any other benefits? I'm sure there are more benefits to fractional shares, right?
Yep, fractional shares give tremendous value to investors because they give them the advantage to buy things that they couldn't have done otherwise. And because fractional shares are becoming more popular, we'll actually see a decrease in the amount of stock splits happening because we can buy them regardless of the price. And the company can now take the cost that they would have used to split their stock and retain it in the business and use it to provide more value to the shareholders.
Okay, thank you very much. That was very interesting. Now, to recap the whole situation for you, yes, doing a stock split doesn't just mean if they cut it up in 5, it's just, you know what, you get 5 instead of having 1. It doesn't work like that. But I'll tell you this, the one thing is the value of a company does change because of that. And if they do it well, they can grow very well over time. But if they don't do it so well, according to the research, Mr. Gunaranta, it could also mess up the company as well. If they're merging all of a sudden and they gotta split their stocks and merge them together as well, it could mess up a company as well. So it's very important that we need to weigh out the opportunities and the cost while investing. And always keep in mind, your stake in that company might change as well because of this, because of the choices of making a stock split. And in the end, hey, taxes will be always luring around, and yes, you might be taxed more just because of the changes that happen to the company, and all of a sudden the government may be luring around because, hey, you're being paid out in cash and all of a sudden you need to pay taxes on that. And in the end, because fractional shares are bits and pieces, all of a sudden your piece of pie may be smaller than before the stock split. And yes, it is just set as is. You know, you can't do anything about that.
That's it for this video. I hope you had as much fun watching it as we did creating it. Lukas is such a tremendous business partner, and I hope you check out his YouTube channel. Make sure you like that smash button, buy stock in both our subscriber counts, Liberty Bell that notification icon, and thanks for watching. Until next time.
And of course, thank you very much, Jessie, for you joining in today, making this collab video. I know it was a bit hard, you know, shooting the video in your part and in my part, but I hope that you enjoyed watching our video together on these stock splits and of course the tricks that were behind it. And I hope that you learned from it. I hope that you liked it very much. Be sure to hit that like button, of course, if you liked the video. And of course, subscribe to both of our channels if you like the content that we're shooting just like this. And of course, if you want to be notified every time a new video comes out, be sure to hit that notification bell as well. I thank you very much for watching, and I'll see you on the next video. Bye-bye, and happy investing.